I think what we saw was a preponderance of large and mid-cap fund managers to chase alpha down in this space, and that weight of money came in, and so long as these companies were delivering earnings upgrades, they didn't really focus on valuation. They went, okay, it's delivering earnings upgrades, I'll buy it, it's going up. We've got an approach that focuses on what the underlying valuations are, and they seem to get very, very stretched. The trigger point for that was prior to the US election, the realization that interest rates were bottoming and going to go up, and as that became more and more of a concern, you had the valuation starting to come into play. You also had the relative outperformance of banks and resources starting to focus some of those largest fund managers back into, well, wait up, I'm suffering from performance because I'm not in these stocks. Maybe the game's up here in smalls and mids. It is a little bit overcooked, and I've got to start that rotation back. It's not too discernible at the moment that credit availability is drying up. There's no credit crisis. It's just that the delta on the availability of credit is going to change. Instead of being very easily available, very loose credit conditions, just starting to tighten up, and that starts then influencing a lot of risk taking, because people start going, well, this riskier stuff that I was buying because I could get access to this really cheap credit, well, maybe I've got to reassess the risk return balance, and these things aren't as attractive. So we're not seeing any signs of real concern. Though I note in China in the last week or so, the government's trying to tighten up credit availability to some of the lower credit qualities, and there's been an increase in number of Chinese corporates that are defaulting when they've gone into offshore markets in the last year. And it's just those little signs there that credit, and it's also the cost of the credit that will potentially drive earnings downgrades to companies who've benefited from the credit inflating their asset values and increasing their ability to increase dividends because their interest costs on those inflated assets are lower.